Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I'll be going through 3 of the most attractive looking UK dividend paying stocks on the market right now that you could consider adding to your personal portfolio. The first stock we are going to look at today for the month of May is Taylor Wimpey PLC, and it is a prominent UK-based residential developer listed on the London Stock Exchange under the ticker symbol TW and is included in the FTSE 100 index. The company specialises in building houses across the UK. It was founded in 1880 and operates through 22 regional businesses across the UK, delivering a range of homes from apartments to detached houses. The company also has a presence in Spain, focusing on second homes in popular coastal regions. As you can see on screen, the current price of the company is £1.15. They are based in the United Kingdom, part of the consumer discretionary industry, have a market cap at 4.09 billion. They went public in 2007, have a current dividend growth streak at 3 years, a 3-year dividend growth rate at 5.02%, and a massive dividend yield currently sitting at 8.08%. And the reason it's so high is due to that stock price plummeting over the last 6 months, as you can see from the graph, down over 25% in this period. I think this stock is a great one to buy in May 2025 as a dividend investor, because Taylor Wimpey is one of the UK's leading home builders with a substantial land bank of over 100,000 plots ready to develop. This positions the company well to capitalise on housing demand, especially in light of government initiatives aiming to construct 1.5 million new homes over the next few years. The stock is currently trading below its book value with a price to earnings PE ratio of 11.6, which is lower than its historical average and peers. This suggests that the stock may be undervalued, presenting a potential opportunity for value investors. Although it does have that massive current dividend yield, the dividend payout ratio is very high and currently over 100%, which wouldn't be maintainable. This does raise concern about the long-term sustainability of current dividend levels, particularly if earnings do not increase. Having said this though, over the last 3 years, the company has managed to increase the dividend at an average rate of over 5%, so hopefully the books will be more balanced and it can continue, and I don't see this particular company going anywhere in this industry. If we have a look at their 12-month Wall Street estimate, we can see that even on the worst case price, they believe they would have an 8% upside, and on the average and best case price, having massive 24 and 59% upsides. Their intrinsic value does, however, sit at 106.48 GBX, also known as £1.06, which is a 9% overvaluation on that current price, so that is something to bear in mind. Taylor Wimpey presents a mix of high dividend income and potential for capital gains, making it an attractive option for investors seeking value and income. However, the sustainability of its dividend and exposure to market volatility are factors to consider. As always, it's advisable to assess how this investment aligns with your overall portfolio strategy and risk tolerance, but at these current prices and with that major share drop recently, could this be one that's good to add to your portfolio right now, or do you think there are better options out there currently? The next stock in my May 2025 buys is Legal & General, stock ticker LGEN. Legal & General is a prominent British financial services company specialising in life insurance, pensions and asset management. It's also listed on the London Stock Exchange and part of the FTSE 100 index and holds a significant position in the UK financial sector. The company plans to return over $5 billion to shareholders over the next 3 years through dividends and share buybacks. This includes $3.6 billion in dividends and proceeds from the sale of its US life assurance business. As you can see on screen, their current price is £2.37. They are based in the United Kingdom, part of the financials industry, have a market cap at 13.85 billion, went public back in 1979, have a very nice 9-year dividend growth streak currently, and a 3-year dividend growth rate at 5%, with a huge dividend yield at 8.99%. As you can see over the last 6 months, they have performed okay, being up 3.3%. Having said this though, I don't think there could be a better time to buy Legal & General than right now with that forward dividend yield over 9%. And if we look at the bigger picture, the price has actually been falling since 2022, and over the last 10 years, the stock is flat. So does this show no growth in the stock or a good opportunity to buy? Legal & General is in a very competitive business, and the insurance sector needs a very long time horizon, as it can be very volatile with plenty of short-term ups and downs. With this sector, you always have strong economic pressure, and we've certainly seen plenty of that in recent weeks. I do still expect plenty more to come, so this share price could be in for a rocky ride over the short term, but it is a sector that I do really like long term, and Legal & General presents a strong case to be part of your portfolio. Under CEO Antonio Simos, Legal & General is undergoing a strategic shift to streamline operations and focus on core areas such as pensions, asset management and insurance. Additionally, Legal & General plans to handle 50 to 65 billion in pension deals in the UK by 2028, increasing its previous target, showing great overall growth within the company. Their 12-month Wall Street estimates also shows that on the average and highest forecast, they see a 12 and 48% upside, and their intrinsic value currently shows them to be valued at £3.38, which means they are currently undervalued at 30%. Legal & General presents a compelling case for investors seeking high dividend income and potential capital gains. The company's strategic restructuring under new leadership aims to enhance operating efficiency and focus on growth areas. However, as a potential investor, you need to consider the sustainability of its dividend payouts and the company's sensitivity to market conditions. I'm always as transparent as possible on this channel, and I will admit I do actually own this stock currently in my portfolio, and if the stock price continues to drop closer to that £2.20 mark, then I think I will potentially be buying back in and adding to my current position. The final stock we are going to look at in today's video is WPP PLC, stock ticker WPP. It is a leading British multinational communications and advertising company. Recognised as one of the world's largest advertising firms, WPP offers a comprehensive range of services including advertising, public relations, media investment management, branding, and digital marketing. The company operates through a network of renowned agencies employing over 100,000 people across more than 100 countries. Their current price is £5.55. They're based in the United Kingdom, although have a lot of work over in the United States. They are part of the communication services industry, have a market cap at 5.99 billion. They went public back in 1990, have a current dividend growth streak at 4 years, have a 3-year dividend growth rate of 14.13%, and also boast a very nice dividend yield currently sitting at 7.09%. As we can see from the graph, over the last 6 months, this company has had a very rocky ride, being down 32.58%, but does that now mean that they present a good opportunity to buy the stock? Well, I do rate WPP as the riskiest out of the three that I've looked at today. The media agency has fallen from its former glory under founder Sir Martin Sortell. It's really been out of favour since his controversial departure in 2018. Due to this slump, I can remind you all that the share price is actually back to what it was at the start of the century. With this, as we talked about earlier, it does now mean the dividend yield sits at over 7%, and the forward PE ratio is now under 9. Under current CEO Mark Reed, WPP is undergoing significant restructuring to streamline operations and focus on high growth areas. The company is investing $100 million in artificial intelligence to enhance its creative and media services. Additionally, WPP is considering expanding its presence in the US market, which accounts for 38% of its business. Earnings are forecasted to grow by approximately 5.37% per year, and their current dividend payout is well covered, so I'd hope the dividend yield will remain at this level, which is very promising for any dividend-focused investor. Today's monthly buys, I've really focused on showcasing some higher yielding stocks that still have potential for some good gains within the stock price itself. I know a lot of people like to see these types of stocks, hence why I've included them today, so please let me know your thoughts in the comment section down below. WPP's 12-month Wall Street estimates, we can see even on that lowest forecast, they believe they're going to have a 5% upside, with the average and highest forecast having massive 32 and 90% potential upsides over that next 12 months. They are also showing a very healthy intrinsic value. When plugging in my numbers, we can see on the base case, their intrinsic value is valued at £8.09, which is a 31% undervaluation on that current price. WPP presents a compelling opportunity for investors seeking high dividend yields and potential capital appreciation. The company's strategic initiatives, including significant investments in AI and potential US market expansion, position it well for future growth. However, investors should remain mindful of the cyclical nature of the advertising industry and monitor the company's performance closely. Could you be looking to add any of these high yielders to your portfolio? Let me know in the comment section down below. Thanks for watching this video today. If you're building a portfolio for passive income and financial freedom, don't forget to like, subscribe, and hit the bell notification so you never miss an update. Until next time, keep compounding and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.